Imagine getting paid every single month, just for holding the right stocks. That's the power of dividend investing. But here's the thing, most beginners chase high yields and end up losing money. In this video, I'll show you exactly how to build a dividend portfolio for monthly income. The smart, beginner-friendly way. Beginners often think dividend investing means buying the highest yielding stocks they can find. But that's a trap. Some companies pay big dividends right before cutting them. Others are so risky that your capital drops faster than your income grows. The secret isn't chasing high yield, it's choosing reliable dividend payers that grow consistently. In this video, you'll learn how to pick safe dividend stocks, how to diversify your holdings, and how to build a portfolio that sends you passive income every single month, even while you sleep. Step 1. Understand what dividends are. So, what exactly is a dividend? Simply put, it's a portion of a company's profits paid out to its shareholders. Think of it as your reward for owning a piece of a successful, profitable business. When a company performs well, it often shares that success with its investors, typically on a quarterly basis, but sometimes monthly. Step 2. Know what a good dividend yield looks like. Not all dividends are created equal, however. The key is to focus on companies with a strong, proven track record, ideally a 5 to 10-year history of consistent dividend payments. This consistency is a powerful indicator of a company's financial health and its commitment to its shareholders. It's about investing in businesses that have stood the test of time and continue to generate reliable cash flow. While high yields can be tempting, a healthy dividend yield typically falls within a more conservative range, usually between 2% and 6%. This range often indicates a company that is stable, profitable, and committed to returning value to shareholders without overextending itself. Anything significantly higher, say 8% or 10%, should immediately raise a red flag. Remember, yield rises when a stock's price drops. A very high yield might mean the market has lost confidence in the company, causing its stock price to fall, thus artificially inflating the yield. This often signals trouble ahead, making such investments risky. Focus on the quality of the company and the sustainability of its dividend, not just the percentage. Step 3. Use simple metrics to find reliable dividend stocks. To identify truly reliable dividend stocks, you don't need complex financial models. 3 simple yet powerful metrics can guide your decisions. First, the payout ratio. This tells you what percentage of a company's earnings are paid out as dividends. A payout ratio below 70% is generally considered healthy, leaving enough room for the company to reinvest in its growth and weather economic downturns. A ratio above 100% means the company is paying out more than it earns, which is unsustainable. Second, dividend growth rate. Look for companies that consistently increase their dividends year after year. This demonstrates financial strength, confidence from management, and a commitment to shareholders. A growing dividend helps your income keep pace with inflation and boosts your overall returns over time. Third, free cash flow. This is the lifeblood that funds dividends. Free cash flow represents the cash a company generates after accounting for cash outflows to support its operations and maintain its assets. Strong, consistent free cash flow ensures the company has ample resources to pay and grow its dividends without relying on debt. These 3 metrics, when used together, provide a robust framework for selecting high-quality dividend payers. Step 4. Diversify your dividend portfolio. Never put all your eggs in one basket, especially in investing. Diversification is your shield against market volatility and sector-specific downturns. Relying on just one stock or one industry exposes you to unnecessary risk. If that single company or sector underperforms, your entire income stream could be jeopardized. The smart approach is to spread your holdings across at least 5 different industries. Consider sectors like healthcare, utilities, consumer staples, energy, and financials. Each of these sectors tends to behave differently under various economic conditions, providing a natural hedge. This strategic diversification protects your income if one sector faces headwinds, ensuring your overall portfolio remains stable and continues to generate consistent payouts. Step 5. Set up DRIP, Dividend Reinvestment Plan. Here's a secret weapon smart investors use to accelerate their wealth accumulation: the Dividend Reinvestment Plan, or DRIP. Instead of taking your dividend payments as cash, a DRIP automatically uses those payments to buy more shares of the same stock. This simple act unleashes the incredible power of compounding. More shares mean more dividends in the next cycle, which then buy even more shares, creating a virtuous cycle of growth. It's like a snowball rolling downhill, gathering momentum and size with every turn. Over time, this compounding effect can significantly boost your portfolio's value and your passive income stream, allowing your money to work harder and grow faster without any additional effort from you. Step 6. Build for monthly income. One of the most appealing aspects of dividend investing is the potential to create a monthly income stream. While many companies pay dividends quarterly, you can strategically combine different stocks to receive payments every single month. The trick is to select companies that pay out in different months. For example, you might pair a stock that pays in March, June, September, and December with another that pays in January, April, July, and October, and a third for the remaining months. This thoughtful arrangement smooths out your cash flow, ensuring you receive a dividend check every 30 days. This consistent income can be incredibly empowering, providing a predictable financial rhythm to your life. Step 7. Start small. You don't need a massive fortune to begin your dividend investing journey. Thanks to fractional shares, you can start with as little as $50 a month. The most crucial ingredient isn't the size of your initial investment, but consistency. Regular, disciplined investing, combined with reinvesting your dividends, allows time to work its magic. Every small, consistent contribution adds up, and with the power of compounding, those modest beginnings can grow into substantial wealth over the years. Don't wait for the perfect moment or a large sum of money. Start now, stay consistent, and let the incredible power of dividend investing build your financial future, one small step at a time. Imagine 5 years from now, your dividend portfolio is paying you $200 every single month. Fast forward 10 years, and that figure could easily be $800 or more. This isn't luck. It's the direct result of disciplined, strategic dividend investing. You're not just buying stocks, you're building a foundation for genuine financial peace. This peace comes from knowing your money is working for you, providing a safety net and the freedom to make choices that align with your values. It's the quiet confidence that comes from a growing, reliable income stream. Financial peace is built, not found, and dividend investing is one of the most powerful tools to construct it. If this guide has illuminated the path to passive income and empowered you with new knowledge, don't keep it to yourself. Hit that like button to support our mission of making investing accessible. In our very next video, we'll dive even deeper, revealing how to find the absolute best dividend stocks for 2026 and equip you with advanced strategies to avoid those common dividend traps. Don't miss out on your blueprint for passive income. Subscribe now and join our community of smart investors.